Personal finance practice problem using Excel. Add-on interest rate loans. Prepare to get financially fit by practicing personal finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we're in the practice tab as opposed to the example tab. The example tab in essence being an answer key. We have the information on the left-hand side. We're going to populate that into the blue area on the right-hand side. We're looking at an add-on type of loan, a little bit different setup than a standard installment type loan that we're typically used to. We'll then do some comparisons to an installment loan, so we could do some comparing and some contrasting. This might be a loan that you could see in certain auto type loans. It's actually a little bit easier to set up in some ways. So if you were to set up a loan, it could be a little bit easier to do without, as much amortization table and whatnot for it. But again, it can be a little tricky when you're comparing and contrasting it to a standard loan. Although the standard installment loan seems a little bit more difficult to put together because of the way the installments kind of work and the breakout between interest and principal. It's kind of the standard, so that is one that we could possibly be comparing to a little bit more easily. So let's take a look at what we have here. We got the auto purchase price. We're purchasing an auto, $17,000, cash $3,100 that we have. Therefore, the difference is the amount that we're going to finance, $13,900. We're looking and then shopping around for loans for that $13,900. We have an add-on rate loan, which has an interest paid on the full amount of the loan, even though a portion of the principal is paid back. So we'll kind of see how this works as we set up the loan. But the idea is that you're paying interest even though the principal has decreased. And when you look at the installment loan, the basic concept is as the principal goes down periodically when you make the payments, then of course you're only paying the interest on the reduced principal amount. That's a little bit more complicated though, however, in order to kind of figure out. So we'll take a look at it here and do the contrasting. We're going to say that we're going to borrow years borrowed, 4 years, and the rate's going to be the 9%. So the first thing we'll do here is we're going to set up the loan. We're going to say this is a loan and calculate the interest for the full time period, the 4 years, with a simple interest for 1 year, and then we'll just multiply times 4, and that's the interest we're going to pay throughout the year. So we'll say loan is going to be equal to the $13,900. The rate of the interest rate is going to be equal, we said, to the 9% down here, 9%, and then we'll make that a percent by going to the number group, percent define it, font group, and underline it, and that's going to be the interest for a year. So we'll call that interest per year, let's say. Multiplying that out, this is going to be equal to the $13,900 times the 9%. That's going to be the $1,251 about. Then we're going to say that we have 4 years that we're going to be covered. Years are going to be 4 years, and we'll just say that equals 4. So that means we're going to have, let's underline this while we're here, font group and underline. That means we're going to have interest for the life of the loan. Interest, let's say total interest. Total interest is going to be equal to the $1,251 times 4. Now, if you saw that setup, you might be saying, well, that means that you're going to pay back the principal and the interest at like the end of 4 years. That would kind of make sense if that was the case. But no, we're still going to be paying it off monthly. But notice we're paying the entire amount of the interest because we pre-calculated it on the entire loan balance. So now we're going to figure out our monthly payment. So it's a little bit different than the installment note, which we'll compare it to shortly. And we'll see kind of the consequences to some degree of it. So now we're going to say, all right, well, how much are we going to pay back then? Well, we're going to say that the total payments are going to have to be equal to the loan balance plus the interest that we're going to pay. So the total payments are going to be equal to the loan, which is, I'm going to put on the inside here of that $13,900. And then we're going to pay back the interest. So the total interest that we just calculated. And we're going to pay that entire amount in interest. We're going to go to the font group and underline. So that's going to be the total payments that we'll have over the life of the loan. Let's do some indentation here, selecting these 3 cells, alignment, indent. Let's indent this one again, making it look nicer. Indent, there we got it. Then we'll use the trusty sum function in the outer column. Trusty sum equals the SUM, shift 9. I'm using the keyboard now, left arrow, up arrow, holding down shift and up, and then closing it up and enter. So we've summed it. We summed it, and then we're going to say the payments that we have, the payments, let's call it payment periods, It's going to be monthly, we're going to assume. So we're going to just say there's how many years? There's 4 years, and there's 12 months in a year. So we'll do the good old multiplication. 12 times 4. So months in year are going to be 12, not 1, 12. 12 months in a year. Then we're going to go font group and underline, and that's going to give us the payments. That's going to give us our payment periods. Payment periods. Multiplying that, this is going to be equal to the 4 times the 12. And let's do some indentation there, selecting these 3 cells, alignment, indent. Selecting this one, we're going to say indent again. And let's put an underline here, font group and underline, and that'll give us our payment per month, which is going to be equal to the 18,904 divided by the 48,000, about 394. Let's add some pennies to it, 394.83. So you can see the process. It's kind of an easier thing than doing the installment loan in essence, but it's kind of confusing because if I'm comparing that 9% interest rate to an installment loan, if you think about this, like, well, what exactly is happening here? Because I mean, normally when the principal goes down, you pay less on the loan, but this time I calculated the simple interest for the entire loan period, which is 4 years. And so it seems like I'm paying more than 9% interest because I'm paying interest even though I'm paying down, part of the interest and principal with each pay. It's kind of confusing. It's kind of easy to calculate because we're just going to say, hey, look, 4-year loan, we're going to charge you simple interest even though you're paying part of it back over the term. So we're just going to calculate the interest. That's how much interest you're going to pay over the life of this thing. And then we just add it to the loan balance, and then we just divide it by the number of periods, and you just pay that per period. Nice and easy. But then you might ask, well, how would that compare to like a normal loan where you pay back the installments and the loan balance goes down over time and so on and so forth? If I wanted to look up other loans that are over the same period and they were normal installment loans, how can I do a comparison? Well, one thing we can do is we could say, well, what if I took this 393.83, which they're telling me I have to pay over 48 periods, which is 4 years, which makes sense. And what if I was to do that into a normal loan to finance the $13,900? What would be the rate? Meaning, if I was to make this series of payments over 48 periods to finance that $13,900, what would be the rate that I would have to use to do that under a normal kind of installment loan? It's not going to be 9%, right? We're going to say let's do our trusty rate formula over here equals the rate. Shift 9, I'm going to say the number of periods is going to be this 48, 4 times 12, comma, and then the payments that we're going to have are these payments that we figured out. It's like, well, what if I made those payments for 48 periods, comma, and then for the loan amount, which was the $13,900, not the loan plus the interest, just the actual loan that we're doing the financing on. If we were to do that, then I need a negative number in there. I forgot the negative again. I did it on purpose, but not really. So here we're going to say the payment here, I'm going to put a negative sign in front of the payment and enter. And then let's percentify that, number group percentify, add a couple decimals. And then I also need to take that and multiply it. Let's multiply it times 12. Okay, so there we have it. Let's do it one more time just because I kind of butchered that. One more time, we're going to say equals the rate formula, shift 9, the number of periods. Number of periods is going to be 48, which is 4 times 12, comma, the payment is going to be for the amount we calculated down here, the 393.83, and then comma, the present value is going to be the loan amount, which is the 13,900. I'm going to close it up. Now that would give us then the monthly rate amount. So I'm going to take that entire thing and multiply it times 12 to get to the yearly rate amount. And then I have to put a negative, double click it. I've got to put a negative in front of the payment. And then we get our 15.99, which is a whole lot different than 9%, right? So these two loans come out. So if you want to compare the two, you gotta figure them out. So this one, now obviously when you do this payment and you calculate it, then you're going to say that you're just going to do our amortization table. We can do the standard amortization table that would look like this. And we can bring that on down to 48 periods. And this last one's going to be the total down there. And then we can center this by going to the alignment and center. And then we can pick up the loan balance, which is going to be equal to the 13.9, and you'd be making your normal payments, which are going to be equal to what we calculated down here. Just to verify this, I'm going to select F4 on the keyboard, $ before the F and 17. You only need a mixed reference, but an absolute works. And then we're going to pick up that 13.9 times the 15.99 absolute reference, F4 on the keyboard, $, before the I and 2, and then divide by 12 because this is a monthly period. Then we'll subtract these two out, the 394 minus the 185, and then finally we'll subtract these out, the 13.9 minus the 209. Selecting those four cells, double-clicking on the fill handle tab, brings it on down, and so there we have it. So we can kind of prove that calculation here. The totals, however, should be totals. Let's do the sum function down here, the trusty sum, up arrow, and then we're trying to get to the summit of the summit, so we can sum it, like at the top of the mountain, we're summing it, summit, with the summit function, and then closing it up. So we summed it, and that's going to be the 18,904. That's the height of the mountain in dollars. And then, because it's a summit, okay, I'm not going to do that anymore. Shift 9, we're going to summit this one, sum this one up, climb into the summit. And there we go. We're going to climb up there. There we have it. Okay, and then this one, I'll just copy this one across. So there we have it. And so that looks good. And so we can kind of prove this one. And when we make our payments logistically, if we were to break these out, we'd have to break it out between the interest and principal. And we got this nice breakout here for us, although the difference will change with each period. This one over here, again, it's kind of easy to calculate to figure out how much we're going to pay off. But when you actually record it, if you're trying to record like the interest and principal payments, it's a little bit confusing. Because first of all, you're assuming the interest is like this 9% of the 4 years, and it's a simple interest calculation, and then you're kind of assuming that they're going to be the same interest per portion per period in essence. But in reality, I mean, if you were to use generally accepted accounting principles on an accrual basis, they might want you to kind of figure out. I've never actually done a simple interest, used a loan taken out like by a business and had to convert that to generally accepted accounting accrual concepts. But in any case, I would think that you could run into problems with that. But in personal finance situations, then you could put this on the books on, in essence, a cash basis system in a couple different ways. But I won't get into that now. It's a little bit different though than the standard installment loan.